When it comes to the fixed income side of things, in the last bond auction, we saw yields on the 20-year bond move up significantly from less than 9% to 10%. Let's run through some of the rationale behind that movement we've seen.
Morning, Alishia. There are a number of things that have caused this rise in yields on the long end of the federal government bond. First, is the fact that there's been a realization that it doesn't really make sense for people to buy 20-year bonds at rates significantly lower than where the inflation is, especially when there isn't a 20-year expectation that the inflation rates will be at those levels. What would be logical would be a situation where, based on the liquidity which we're seeing now, which is a bit temporary, the effect is felt more on the short end of the federal government bond curve. And largely, the 20-year bond remains where it is. Plus the fact that in recent weeks, with the passing of the AMCON and one or two events that have happened, we're beginning to see normalcy return to the markets. And there's also an expectation that as this happens, banks will start to lend, and this would also tell on liquidity, which might push the rates back to the levels we saw last year, which was somewhere between 11 and 12%. So I think most players are beginning to realize that sitting on the long end of the federal government bonds at single-digit levels is not exactly a wise thing to do.
Well, implications then, Sola, for corporate bond issues, because we know that we've seen a property company planning to issue its first real corporate bond issue, and we've had quite a few banks as well announce their intentions to go and raise capital via a corporate bond issue, but none of that really coming to the fore.
Okay, there were a number of banks who were at the later stages of issuing their corporate bonds. I think what happened then was they realized that the rates were dropping and it wasn't a good time to lock in on long-term funding. Now that the rates seem to have bottomed out, I'd expect that this is the time when most of them would begin to lock in on long-term funding. Again, we're expecting to see a corporate bond for UPDC come out in the market soon. And I think the key thing to note here is, like I'd said previously, is that we just might begin to see the market turn. And if there were any corporates who were looking to get long-term funding at relatively good rates, this probably might be the time, because that window of opportunity seems to be closing slowly.
Well, very quickly, on the currency side of things, we've seen the Naira appreciate this week. What's your outlook as we head into next week for the local currency?
Well, for next week, we expect the Naira to remain within the 150 levels and probably, or maybe lower, because there's an expectation that the NMPC is going to sell a significant amount of FX in the market. Right now, where the market is at about 150 on the figure, and the central bank effective rate is at 150.23. Demand at the central bank has diminished significantly, and we don't expect to see any pressure on that side to provide FX to the market. So for the next week or so, or probably even for the rest of the month, we don't see any major volatility on the FX side.